Good afternoon. Welcome to our presentation of the Deloitte Regulatory Outlook for Financial Services in 2018. I'm David Strachan. I run the Deloitte Centre for Regulatory Strategy in Europe, the Middle East and Africa, and I'm delighted to be joined today not only by you, our audience, but also by Andrew Bulley, my fellow partner in the Centre, and an outstanding panel of industry and Deloitte experts. We've split our regulatory outlook for 2018 into three sections. The first identifies 7 thematic issues of strategic significance for all sectors of the financial services industry. I'll concentrate on these themes in my introductory remarks. The second section highlights a number of issues we consider to be supervisory constants. Although we don't see any new formal policy initiatives in these areas emerging in 2018, they need to be given the attention they deserve by firms owing to the high importance placed on them by supervisors. Last but by no means least, we present our views on some strategically significant sector-specific issues. Our panel of experts will delve into these in greater detail. Those of you who are participating online today are very welcome to submit questions for our panel. We'd really encourage you to do that. So let me start with some general observations. This time last year, we expected 2017 to be a period of uncertainty for the financial services industry. Among other things, there was a lack of clarity over the final shape of post-crisis reforms and the implications of Brexit to deal with. We also saw pressures on the industry from sluggish economic growth, low interest rates, as well as competition from new entrants. Looking ahead to 2018, it seems fair to say that many of these challenges and uncertainties remain. However, the last thing you want to hear is us banging on about how difficult it all is. We know that. Therefore, the fundamental task that we've set ourselves in producing the outlook is to cut through those challenges and uncertainties and help you, our clients, find a path through them. With that in mind, I'll now turn to the first of our cross-sector themes, meeting multiple regulatory deadlines. The first 5 months of 2018 has a concentration of regulatory deadlines, which in combination touch all sectors of financial services. There's MiFID II, PRIPS, the EU Benchmarks Regulation, the Insurance Distribution Directive, the Revised Payment Services Directive, and the GDPR. The focus on meeting these in such a short space of time will come with a significant opportunity cost. Firms won't have been able to exploit the potential synergies that exist between various of these regulations and will have to divert resources from other strategic priorities. In a number of areas, we're expecting some firms to have to undertake significant remediation work after the deadline to make compliance more efficient and effective. Now, some implementation work will inevitably overrun regulatory deadlines. Firms may need to act swiftly to identify areas where they may be at risk of not being fully compliant and plan accordingly. And although some regulatory authorities have publicly recognised the challenges of getting over the line in time, there is no room for the industry to relax. In all reality, many firms will have to make ongoing changes to implementation plans throughout 2018 to ensure that they are working towards strategic solutions that will deliver optimal operating models. This means that controls optimization is likely to be a multi-year programme. Now, our next issue is Brexit and what firms can do to move forward given the uncertainties surrounding the subject. We expect those firms operating in the UK that need to ensure continued access to EU markets to start building their presence in EU 27 countries on a sliding scale of intensity throughout 2018. To be clear, we don't think that restructurings will be completed in 2018. Instead, they're going to occur in waves over a number of years, depending on the final terms of any market access agreement between the UK and the EU. A key issue is whether a transitional period will be agreed. And as you'll be aware, this is undecided at present. But even if an agreement is reached, firms are still likely to press ahead with aspects of their plans, including new authorisations and model approvals. Given all this work underway, we expect the European supervisory authorities and the ECB to continue to drive for consistent supervisory treatment of relocating firms. But there's also going to be a strong element of supervisors learning by doing. This means firms should expect supervisors' expectations to develop over time as they learn more about the specific challenges in relation to restructuring work and related authorisations. It'll be an iterative process. Next up, we look at the relationship between data protection, innovation, and good customer outcomes. We live in an increasingly data-heavy world, with more and more tools at our disposal to analyse data in novel ways. Now, for financial services firms, this creates huge opportunities, but also risks. And in particular, we see increasing concerns about the use of personal data and data privacy. As a result, the industry can expect greater supervisory scrutiny of the way in which it uses and controls personal data. And that's particularly true of those firms whose business models rely on wholesale processing of customers' personal data. Most significantly this year, the EU's General Data Protection Regulation will take effect in May. Now, that will give consumers additional rights to understand and take control of how firms are using their personal data. Firms will have to carry out data protection impact assessments, not only to satisfy supervisors, but also to enable them to respond to customers' inquiries in a meaningful, transparent, and understandable way. And GDPR compliance isn't, however, the end of the story. Conduct supervisors will be paying attention to any unintended consequences of the automated processing of large data sets. For example, the potential for financial exclusion and discrimination, and what this means for consumers who might be considered vulnerable. Now, that point moves us neatly on to our fourth theme, a broadening of the way in which supervisors think about customer vulnerability. Regulators are increasingly recognising that legislation, products, and the services are often built for the average consumer. And while that means that things work well enough for many, supervisors have a responsibility to consider customers whose situational vulnerability may mean that they are less able to look after their own interests and hence are at greater risk of suffering harm. Now, as a result, we're seeing a general shift in conduct supervision strategy. While firms have to treat all their customers fairly, conduct supervisors will increasingly focus their resources on groups of customers at greatest risk of potential detriment or harm. At the same time, those supervisors are broadening their understanding of what it means for a customer to be vulnerable. Essentially, supervisors are recognizing that an individual's vulnerability is dynamic and a function of many variables. It's not just a case of someone's income, but will be based on health, age, life events, and other factors that may change over time. The industry will need to adapt to the broader definition of vulnerability and factor it into their governance and interactions with customers. Building that very important capability to monitor vulnerability factors over time will be crucial and will need to be supported by strong board and senior executive engagement and enhanced data analytics. Next up, we turn our attention to cyber risk and resilience. Now, clearly, the regulatory focus on cyber risks isn't new, particularly in light of technological change and increasingly digital business models. But in 2018, we are likely to start to see regulators articulating clearer priorities in this area. Now, one shift of emphasis we expect in 2018 is driven by the heightened risk of cyber attacks which may threaten financial stability, going beyond affecting an individual firm. The increasing interconnections between financial services firms and their outsourcing partners, particularly their technology partners, add to the challenge of dealing with what are increasingly becoming jointly owned systemic cyber risks, especially when you consider the cross-border element to many firms' arrangements. In the insurance industry, in particular, prudential supervisors, we expect that they'll take a close interest in stress testing and reserving practices. EIOPA has indicated that it will look to incorporate some qualitative elements relating to cyber risk in its 2018 stress test. Conduct supervisors, on the other hand, will be alert for signs about whether policyholders have concerns about the coverage of policies they've already bought and whether they provided adequate protection against the cyber events they've experienced. Our sixth theme is about internal models, those models that financial services firms use to manage their risks and to generate capital requirements. Now, it seems clear that regulators in Europe continue to see value, real value in modelling as part of the regulatory framework, even if they do so with, at times, differing levels of enthusiasm. But there remain general concerns in some quarters as to whether models are fulfilling their intended role in adequately capturing and calibrating risks. And there are also concerns as to whether model risks are well understood and managed by boards and senior executives. In the light of this, firms, we think, will need to demonstrate that they've considered the inherent limitations of their models and that they understand the circumstances in which key model assumptions and dependencies might break down. There are two immediate drivers for supervisory interest in models. The first, at the Eurozone level, is the ECB's fieldwork for its targeted review of internal models. That fieldwork will be substantially complete by the end of 2018. As a result, some banks can expect to be asked to carry out remedial work from that review. The second, and very importantly for insurers, is the forthcoming guidance from EIOPA again on internal model convergence for insurance. All these things point to the importance of model risk management frameworks. That is, the governance and oversight of the deployment of models and the management of risks that arise from their use. We expect supervisors to scrutinise firms in this area, and we think they'll be particularly interested in the information provided to boards and risk committees that lead them to their decisions over how, where, and when to use models. The last of our cross-sectoral themes is the increasing supervisory interest in financial services firms' business models from a variety of angles. Now, the macroeconomic environment, competitive forces, and regulatory change continue to put significant pressure on traditional business models across the financial services industry. In some cases, they're already driving significant changes to business models, to risk appetite, and to how firms position themselves strategically in the market. Individual firms' business models may be challenged in a variety of ways. For instance, technologically enabled new entrants may be attacking value chains or eating into market share. There may be issues with legacy problem assets, as is particularly true for a number of European banks. There are examples of overcapacity and intense competition in some markets. And not least of all, some firms will be facing a variety of regulatory mandated business model changes. But from supervisors' perspectives, deeper analysis of regulated firms' business models enables them to think much more broadly about their approach to supervision. Supervisory business model analysis played a more prominent role in supervisory activity in 2017, and this will only intensify next year. The result is that business model analysis will increasingly provide a lens through which the supervisors will view the competence and the effectiveness of the board and senior management. And firms clearly need to be ready to deal with this, and they may find themselves under supervisory scrutiny from two polar opposite ends. On the one hand, are firms making sufficient and sustainable returns? On the other, where they are making good returns, have they considered the competition and conduct issues around pricing, fees, customer suitability, transparency, and so on? Now, the title of our outlook this year is Bringing It All Together. And so in closing, I'll try to do just that and pull out some common threads that emerge from the detail of our analysis this year. First, it's clear that the industry is under significant resource constraints with numerous competing priorities. With business models under the pressures I've described, it can be difficult for regulated firms to do the bare minimum, let alone become best in class. Second, the ecosystem of financial services is also clearly and rapidly changing. The capital markets landscape is being redesigned by MiFID II, But we're also seeing old and new players forge new connections, particularly through technology. Third, and speaking of technology, this creates huge opportunities, but also risks, particularly for firms whose business models may be challenged, and risks for consumers where the use of technology is not well understood or well controlled. And fourth, on the subject of consumers, their relationships with the financial services industry and sector are changing. Firms are looking to use technology and data in new ways, but customers are also set to gain much stronger rights over how their data is used. All in all, as the financial services industry enters 2018, it faces a complex landscape, but one which we believe can be navigated with careful planning and execution. On that positive note, I'm going to hand over to Andrew to introduce our guests and then lead us through the Q&A discussion. Andrew.
Thank you. So David, many thanks indeed. Once again, as befits its subject, the Outlook covers a great deal of ground indeed this year, and you've certainly set out a wide-ranging backdrop for our discussion this evening. So good evening, my name is Andrew Bulley. I'm a partner in the Deloitte EMEA Centre for Regulatory Strategy. And I'm delighted to be joined here this evening by a distinguished and cross-sectoral panel of financial services leaders and Deloitte partners who will give us their personal views and perspectives on some of the key themes identified in the Outlook and what indeed may be in store for the regulation of financial services in 2018 and beyond. I'd like to introduce the panel in turn. Furthest from me, on my far left, I'm delighted to welcome Alistair Barber from the insurance sector. Alistair is a non-executive director and audit committee chair at both Phoenix Group and RSA Insurance. But Alistair also has considerable involvement in asset management and banking, since he is also a non-executive director of Standard Life Private Equity Trust plc, Lion Trust Asset Management, Catco Reinsurance Opportunities Fund, and the Bank of Butterfield. Next to Alistair, I'm very pleased to be joined tonight by Stephen Sanders. Stephen is Chief Compliance Officer for EMEA at JP Morgan. His former role was as the EMEA Head of Regulatory Policy Development for JP Morgan. And prior to that, Stephen hitherto was a consultant in the financial services regulatory practice of the law firm Herbert Smith. And before that, he held senior regulatory affairs and compliance and corporate governance roles at RBS Group, Deutsche Bank, J. Rothschild, and HSBC. And he's also authored and edited a number of books on regulation and taught on the subject at the City University Business School. Now, next to Stephen, I'm very pleased indeed to introduce Mark Wharton. Mark is a Managing Director and EMEA Head of Regulatory Relations at Morgan Stanley. Mark joined Morgan Stanley in December 2014 from the Bank of England's Prudential Regulation Authority, where he was a head of department responsible for cross-firm supervision of international banks. During his regulatory career, Mark has worked on a wide variety of issues, which included the creation of the FSA's market conduct and market abuse regime, UK banking supervision, and most recently, cross-cutting regulatory issues affecting investment banks. Now, if I may turn to the home side, I'm delighted to introduce my very good colleague, Cindy Chan, who is a partner in Deloitte's Financial Services Risk Advisory practice. Cindy has very extensive experience in supporting firms on regulatory risk and risk assurance reviews and conduct risk projects covering areas such as product development and governance, sales practices, and suitability assurance. She's also advised a number of firms on their senior insurance management regime and their senior management regime implementation programs. And finally, very pleased indeed to welcome this evening, nearest to me, my colleague Tom Spellman, who is a partner in Deloitte's Risk and Regulation practice. Now, Tom has led a series of major risk and compliance review and transformation programs within both European and global financial institutions. Tom was also engaged by a major European regulator following the financial crisis to advise on how they should assess regulated firms' risk management frameworks. Welcome to our panel. Thank you for joining us this evening. Now, I have a number of questions that I want to put to the panel. However, we do want to make this as webcast as participative as possible, so we invite you to ask your own questions to the panel as well. On your screens, you will find a Q&A chat interface. If you type your questions in there, we will be able to see them, and I will try to raise as many as time allows on your behalf. So, without further ado, I'd like to start with a theme that runs throughout the Outlook document, which is that of business model analysis and the associated regulatory challenges facing firms. As David flagged, we are seeing supervisors, rightly I think, placing increasing emphasis across sectors upon business model analysis. So I'd like to ask the panel really, in relation to their sectors, how much difference is this analysis and emphasis making in practice to firms? Let's start with Stephen.
Thank you, Andrew. So I think looking at firms through the lens of their business model is part of the modern landscape of regulation.
Yep.
It seems to me that it's a useful lens for looking at all sorts of things that are inside the firm if you're a regulator. One of them is governance, another is risk profile, and then in particular in relation to business model, we've seen regulators looking through the lens of business model to look at things like conflicts and thereby at the exercise of competition powers. So I think the business model is very much now a regulatory tool, and it opens up a number of those things inside the firm by means of those sort of toolkits. I mean, I'll just add the thought that, you know, for my own sector, thinking about wholesale banks, there are a number of business model challenges going forward now. Andrew, we spoke earlier about the sort of significant regulatory change that you flag in your publication. And I think coming off the back of that regulatory change, and then also thinking about particular changes in the industry, there are some big business model challenges. So if you take MiFID, a couple of big examples. One will be, how will the industry overall react in business model terms to kind of the end of soft commissions and the inducements regime? How will that affect the buy side and sell side? I don't think anybody pretends to know the answer to that. And then in terms of the kind of markets businesses across the industry, how will the systematic internalizer model work? It's a very new model. It's a very deliberate translation of liquidity into venues in the MiFID regime, and then a kind of a residual space which is venue-like. How will that play? And it is it's not a decorative change, it is a business model change. So I think those are particular challenges.
Thank you. Alistair, how about the insurance sector? How much difference is it making there?
Well, I think I'd start by saying, from my perspective as an audit committee chair, I'm very concerned about the here and now and how things are working at present, with whether eye and what is coming down the road. So I think the regulatory interaction with us, the regulatory intervention with us, is changing as the regulators learn, as they get in insurance industries, as they get comfortable with Solvency II. So we are in a period of change, and it's trying to understand what we're going to be regulated, so how the regulators are going to look at us in terms of what they expect going forward. So right now I think we're in a period of a lot of discovery on the part of the regulator, and thinking on our part about how we respond to that and change. And we're also going through change still as a result of the solvency regulations, forthcoming accounting standard changes. So to me it's a period of some disquiet rather than stability.
Okay, well on that note, let us turn, if we may, to a second key theme which David flagged, which is that of meeting multiple regulatory deadlines. As David noted, an awful lot seems to be converging in the early part of this year. Stephen, do you think the industry and the regulators are going to be ready for all this? And to the extent they're not, do you expect regulatory forbearance to any great degree?
Well, I think that there's a wide expectation, and David touched on this, that MiFID and all of the regulatory change that's going on at the same time, so we have benchmarks around the same time and the rest of the inventory. I think there's a widespread expectation that that's a difficult amount to digest in one go for regulators, for the regulated. And I think realistically, most people expect to have some form of tail of things that they're doing beyond the magic date of January the 3rd. bearing in mind that some of these regulatory changes are interlinked. You know, you can't do some of the things that MAR required you to do some time ago until you can do some of the things that MiFID will require you to do in the transparency space, because you need that data. So I think that there's a widespread understanding there's a lot to do there, and many people will be looking to work the tail. I mean, I think in UK we know that there isn't a formal forbearance regime. I think what one has experienced with the UK regulators is what I'd describe as a very kind of real world view, in which they know how big the task is. They are interestingly focused on the task, but they're also focused on the kind of systemic consequences of pushing one angle of the task at the risk of some of the other risks that might come off that. I think what I would summarise it as is a situation in which the regulators are pushing firms, shall we say, appropriately hard to do the things they need to do in terms of regulatory implementation, and at the same time recognising that, and this is an important point, with regulation still coming out, we had just 10 days ago, another big download of very important interpretative material from ESMA. With regulation still coming out, don't get distracted and go off and run another stream and another stream and another stream. Get the job done, talk to us about what you perhaps can't do and what's just arrived in the skip, because there are risks around not doing the job as you first saw it.
If I could just come in, I'd absolutely agree with that, and I think as you highlight, Stephen, that there isn't a formal regime in the UK for forbearance, unlike some other jurisdictions with no action letters, etc. We have seen in the last year or two a couple of examples where, admittedly rather late in the day, there has been a degree of forbearance exercised in terms of the market as a whole not being impacted by rigid adherence to rules on a particular date. I think, as well as Stephen said, one of the key things here is for firms to be held, very tightly to the requirements of the regulations in the UK. But I do think there is a pragmatic, practical view, and I think it's important for firms to sort of do absolutely everything they can, but at the same time be able to know what is going to be left to be done, what is within firms' control, what are the wider market implications of rigid rule adherence, which I do think is recognised by regulators, not just in the UK but elsewhere. But I think one of the other angles that perhaps we've not touched on yet is, as David set out, the number of regulations coming into force at the same time, the complexity of many of those. We have already in some areas of the market seen some firms being sold to others on account of lack of readiness and lack of preparedness. I think those longer term impacts on the market composition and individual firms' business models will play out over next year and beyond in terms of perhaps, and I'm sure this wasn't an intended consequence of all the regulation, further consolidation amongst some of the biggest players, some threats perhaps in the middle, and the possibility of some sort of smaller boutique firms opening up in certain areas. And I think in aggregate that could be quite an interesting trend to look out for. Clearly not intended by regulators, it sort of cuts across the priorities on improving and promoting competition. But when you look at the aggregate burden and the efforts that the largest, more complex firms have to do, the sheer scale of that is very, very difficult, and I think there will be some players that just find that too much.
Okay, thank you for that. Let's turn to cyber risk. So regulators, I think, with obvious justification, are putting this at the very top of their risk concern and stepping up their efforts. I just wonder what specific supervisory initiatives and interventions you're expecting over the next 12 months in this key area. Alistair.
I'm waiting for standards to appear, to emerge. I'm expecting supervision to focus much more on what firms are doing about cyber. And for firms like the ones where I'm involved, it's in the insurance industry. It is not just in terms of our protecting our own assets, our own data. It's also in terms of our existing business and what I might call latent cyber risk that we have out there. And although we're very minor players in terms of new products that are providing cyber coverage, which is difficult to underwrite the product, The coverage is difficult to quantify. So they're going to, and we're already seeing regulators are particularly interested around all aspects of it. But the one thing I would say is I think when it comes to cyber, it's probably the one area that if you talk to non-executives in the financial service industry, I would say the regulator is coming along and standing behind the board. There is a very
interest here, isn't there?
Yes.
Yeah.
Well, picking up on that point, actually, I think the level of engagement of boards in this area is going to be an ongoing focus of regulators, not just here but overseas as well. It's clearly been a risk on regulators' agendas for a while. I think it's going to move into the expectation will be this is a sort of business as usual risk now. It's a permanent risk, just like many other risks. I think there'll be at one level a push to have a sort of a more mature framework to assessing and mitigating this risk, just as with other risks that firms face. But I also wouldn't be at all surprised if we have more direct interventions to be pushing firms to say, it's one thing to sort of have an identification of what your key risks are. To what extent have firms been stressing their own key systems for resilience, stressing those that have a key place in the financial market infrastructure, the interconnectivity that we touched on earlier, and saying, well, what if, for whatever reason, an algorithm goes rogue, or there's some kind of attack on a system that's core to financial market infrastructure, something which I think we've actually seen an easing off in the last couple of years around perhaps broader market-wide business continuity type exercises with a cyber threat. They have been done in the past, but I think that will come back, if you like, as an area of focus, as well as I say, the board's engagement, the board's level of interest from a governance perspective all the way through the organisation.
I think, if I may, I completely agree with that, and that there's a related point which I think firms have been thinking through, particularly in regard to banks under the SMR regime, and that is where do you put these responsibilities from the board downwards in terms of SMR? Yeah. Because it's pretty axiomatic that the more the regulators scrutinise you, if you are in that regime, the SMR regime, the more that they are likely, of course, to kind of hang it on the hook of, well, okay, where have you got it, who has got it, and where are they? So, it's quite interesting to look at it through the lens of the prescribed responsibilities and how the prescribed responsibilities for financial crime, for instance, overlap into cyber.
Yes. And
is that one person, two people, and which MI do they use? And then you move into how does it relate to SMF 24 and the SMF 17? And do you segment it? Do you say that, cyber risk is systemic, but it's also a financial crime risk that your SMF 17 thinks about? And I think that's a useful way to think about it, because it's probably the way that certainly the UK regulators are thinking about it, systemic and then governance, as you said, Mark.
Okay, thank you for that. Let's turn to the theme of vulnerable customers. Now, this has been a growing theme in conduct regulation, and what one we cite in particular in the Outlook, the FCA statistics about 50% of the UK population displaying potential characteristics of vulnerability at particular points in their life scale. I mean, this is a growing theme. I'd like to understand the panel's views on what this means in practice for firms. I mean, how can firms adapt to this changing regulatory perspective and emphasis? Cindy?
So we're seeing a significant focus around vulnerable customers, and not only from the regulator. It's not a new piece, but I think they've certainly honed their thoughts and perspectives with regards to vulnerable customers, and they've certainly broadened out what they think a vulnerable customer actually is, in terms of ranging not just financial vulnerability, but obviously the elderly, health, etc., etc. The list just gets longer. And the difficulty with that, in general terms, for the organisations that I've been working with, is actually how do you train your frontline staff to actually identify vulnerable customers, given that breadth of scenarios that you could undertake. And that is, in terms of the data capture piece, not only the analysis aspect, but the frontline data capture is genuinely very, very difficult. So what we've seen a lot of organizations undertake is starting to develop vulnerable customer policies, significant programs of training of their frontline staff, the oversight, the governance, the MI, the data analysis that goes alongside that. So fairly significant programs. The other piece that we're starting to see see much more is the use of technology. So when you're looking at voice analytics capabilities, so rather than just waiting for someone to actually tick the boxes as to identifying what might be vulnerable on their core systems, using other analysis such as voice technology to be able to say, actually, are there indications of vulnerability coming out from a conversation? So I would say a very significant area of program and investment.
Can I just put a thought to Mark and Stephen? I mean, is this just a preoccupation for retail firms, or is there other implications for wholesale firms on this as well?
Well, I think there are implications. I think if you'd asked a sort of question about 20 years ago, you would have had a sort of caveat emptor type response, and I think it's quite telling that 20 years on, that isn't really the right response to have. So I think things have moved on, partly driven by the broader market implications of the way wholesale customers have been treated in the past in various markets, which we know about. But I also think we're going to see a continuation of what has been a traditional theme, not least in the UK, which is wholesale firms who are structured as manufacturers of product that does end up in the hands of retail customers will continue to be reminded that they owe obligations and responses as well all the way through. So we have had thematic reviews from the FCA over the last few years looking at retail structured products, where there's a very, very clear emphasis, which I'm sure will continue, particularly with the likes of PRIPS regulation coming in. Target market identification right at the manufacturer stage, even if one is several steps removed from that end customer through that distribution channel. So I think it will continue to be something that wholesale firms as manufacturers will have to continue to keep front and centre.
Okay, thank you. That's very clear. Now, I'd like to turn to a subject which has attracted a lot of interest, actually, and a number of questions flying around, but in particular, model risk management. So in the Outlook, we cite, I think, some really quite striking statistics. 50% of bank credit capital requirements generated through internal models. In the UK, 68% of insurance capital requirements, total balance sheet requirements generated by models, 52% in Germany. Can I ask Tom and Mark and Alistair in due course, is this healthy? Should we be concerned?
I don't think we should be concerned, actually. I think models, as long as they're used in the way that they're supposed to be used and isn't for quantitative, for modeling's sake that we're doing it, that we shouldn't be concerned. But also, it needs to be part of a broader framework. So it shouldn't just be a decision by itself, yes or no, 1 or 0, that we're taking. It's got to be part of a broader framework where we're taking other things into consideration. Now, that's harder in retail in some ways because there's more analytics, there's more data to do that, so people think that answer could come through. But I think, again, it's very important to take the other pieces into consideration. Now, there is another side to this as well for me. When you look at many of the institutions, particularly the global ones, we're looking at 2,000, 3,000, 4,000 models globally across different risk classes, plus then a bunch of calculations on the end of it. I do think, Andrew, we should be looking at reducing that number, simplifying the number of models that are through there. I think the Basel Committee's announcement earlier around the kind of output floors and around the standardised stuff will add some help to that, but it might actually make it more complex because we're not going to rely on external models plus internal models together. So, in answer simplistically is we shouldn't be concerned. I think it's driven that way. I think regulators genuinely do understand what they're getting to in models. They've put a lot of emphasis on sort of input floors and other controls around it, but I do think there is some work that we need to do to simplify that landscape.
Mm-hmm. Alistair, I don't think the insurance sector has these flaws to the same extent. What are your thoughts on that?
Andrew, you used to be a regulator. You know very well. Sort of starting in the macro, I think models and the need for models are here, given that we have self-assessed capital regimes. And so I wouldn't be say concerned, but we need to have appropriate focus on them. We need to have appropriate understanding of what they are, what they do, and how they fit into the business, and when it is appropriate and when not. Back during the journey to Solvency II, there was a lot of discussion around boardroom tables about the use test and directors' involvement. But the use test, actually, when it's disaggregated and look at the components of it, is a very useful way to understand what a model can do, articulate strengths and limitations, when it works, when it doesn't, what things lie outside, and it is helpful as a tool to make business decisions, but they have to be made in context. So I think they're here. I think the focus, I almost hate to say it, I hope we don't change the regime in the short term. We can tinker with it. Yes, risk margins are terrible things. But
we'll probably come on to that.
We need to, we point out, we need some stability to get used to them. In another life, you mentioned the Bank of Butterfield, where we have American accounting standards and regulations. The equivalent of IFRS 9 is arriving as expected credit losses. And there we're in a whole new ballgame with no benchmarks, no framework. And that's where I think the modelling, it's very important, but it's very difficult. And that's where we should be concerned.
Yeah. Okay, so models here to stay, can't be disinvented. Now, as David explained, the outlook looks across sectors, but also then delves into detailed issues around individual sectors. We deliberately structured it in that way this year. So let's turn to the banking sector firstly. And I'd like to seek Tom and Mark's view in particular on this whole issue of potential divergence between regimes. I know there's been some further announcements today, but I'd be interested in your views on how you see the risks of potential further divergence between the EU, US and Asia in terms both of substance and speed of change.
Well, I think it's a very good point, and I think internationally active firms have always struggled with this issue of consistency, both from a substantive perspective as well as slightly perhaps a different perspective, which is consistency from a timing perspective. And I think we will continue, I'm sure, to live in an environment where even if the substance of some of these regulations and regimes is broadly comparable, I'm careful there not to say equivalent, broadly comparable. We'll come on to that perhaps later. Differences in timing can be very difficult because you're going first in one area, you can't necessarily go at the same pace globally. That assumes, as I say, that you're actually going after the same objective at the end. I think it is inevitable that we'll see a bit of a shift in terms of the degree of convergence or divergence across those three blocks, and obviously the biggest question there is the degree to which, where does the UK end up vis-a-vis the EU, and how does that relieve any room for the UK to take a slightly different approach in some areas and perhaps be a more US aligned view. If you dial back the clock another sort of 20 years or so, you had very clear sort of key players, US, UK, Japan, Switzerland at sort of Basel Committee level. That has clearly changed for good reason, and where the UK and the EU end up from a Brexit perspective will be a big factor. I do think some of the FSB statements, for example, are helpful to reinforce the view that there are these generally accepted principles, standards at the global level, but the watchword has always been difficult to then have consistent interpretation and application regionally, but as I say, both in substance and in timing.
Yeah. Okay. Yeah. Tom, a quick thought from you on this?
Yeah, same things. I mean, I do think divergence, where the risk lies with institutions, is the cost that it then drives out in terms of regulatory change programs. What I think the knock-on impact it has on the business models that they need to put in place in different jurisdictions to manage those. I don't see an easy way out of it at this point, because frankly Switzerland tends to be quicker off the mark from Basel, EU a little bit behind, US adopts something usually different but a little super equivalent, and then Asia is always about a few years behind that. I think we've been dealing with those before, so it's about how institutions, and ones we're working with, looking at this a lot, it's how they actually can get the most out of what they're doing without actually spending far too much and then having to rehash the whole thing again at the end. And I think
that's right. And from a practical perspective, it's actually quite difficult to go down the sort of the simplistic route of you go for the higher of standard and apply globally, because you then introduce huge inefficiency.
You do.
And which is just outweighs any sort of apparently simplistic cost of sort of implementing one standard at the same time.
Yeah, no, I agree.
Okay. Continuing our canter through the sectors, so investment management, we quote in the Outlook some ESMA figures on active versus passive. Passive funds returned over a period 5.7% return on investment funds net of costs, compared to 2.1% for active funds. Obviously controversial figures, open to interpretation, but nevertheless quite striking. Alistair and Cindy, is the active business model still sustainable? Cindy, perhaps.
I think it's very challenging because if you look at the asset management study and I guess general focus from a regulator standpoint here in the UK, it's definitely something that the UK regulators are very focused on in terms of the relative cost and charges and against the returns. You're citing one example. I'm sure they've got other examples that they look at in terms of their benchmarks. I think there is a continual pressure for investment management sector overall across all of their products. But I think definitely in the active space, there's particular challenges with regards to relative returns at the moment. I think the wider piece in terms of the landscape, you also see the platform market study. So there's so many components of the distribution and value chain in asset management that's being challenged. And actually for a sector perspective, it's all about thinking around cost efficiencies, what you can do from a business model perspective to get some of those cost efficiencies, a lot of it driven from either competition or actually just the regulatory drives and changes in the level of investment that's required at the moment. So I do think as a sector, there are particular challenges at this current point in time.
Okay, Alice?
Well, I would say yes, and beware of statistics. I think, yes, I do think there is a place for active management. I think it's going to change. I think it's going to become more niche. I think there will be a move to that, and active management that makes a genuine return that is above average will survive. The trouble inevitably is sustaining that. So I see this from both as a buyer and working with a company that's a seller of these types of services. There is a shift coming, and I think in the larger scale, the wholesale, if you like, there is going to be a big move towards passive. I think when one looks at the economics of it, but I do think there will be a niche. I think it will change, and all the things that are happening in the asset management industry right now, particularly around competition, around transparency, is going to change the landscape.
Yeah. One for Stephen. I mean, periodically, central banks cast a spotlight on the size of this industry, at least the balance sheet size of it, and pose the question, could this pose risks for the system? I mean, is it only a matter of time before certain asset managers, at least, are deemed systemic?
Look, I wouldn't want to try and predict that, and I wouldn't want to make a specific comment about asset management companies. What is clear is that on the back of, we're still in, let's face it, post-crisis mode. On the back of a crisis driven through systemic risk, perceived as arising in situations when people don't know what's in the box, and the box is a big box, it matters to the market. The regulators will continue to look at all sectors and say, are we comfortable about the risks in the box, and what are the potential risks in that box? So let's sort of take, as it were, asset management off the table, but I think the regulators' review of systemic risks won't go away.
Yeah. Now, I hesitate to raise this next question, but I guess I'm duty-bound to do so. It's incredibly broad. It's come through. Let me do so. Let me direct it to Alistair and Stephen, if I may. It's on MiFID II, and it's a very simple question. Implementation issues to one side. Is MiFID II a good thing? Answers on a postcard, please.
Go first.
Oh, okay.
I'll give the short answer.
So, is it a good thing? MiFID is a very big thing, and it's a very different thing, and it's a very complicated thing to do. The goodness in it was intended to be in terms of creating more transparent markets. So if you wanted to kind of, the one bullet point about what MiFID was about, I mean, it's subject dear to my heart because before my present job, I sort of spent 3.5, 4 years working on MiFID before it was MiFID. So it's I have a number of years of thinking about MiFID. So in terms of it wanting to be a good thing in all sorts of transparency, transparency is generally regarded as a good thing in markets, and it's certainly delivering a lot of transparency. I think a lot of our concerns about whether it would be a good thing in practice, going back to that earlier time, were around how that transparency would be calibrated. And I think everyone feels that, for instance, the I mentioned earlier, systematic internaliser, the sort of normal market size calibration and so on. Those things have settled in what looks like an okay place and not such an alarming place as some of the pre and post trade transparency stuff looked as though it might be. But I think we still have a long way to go before we know what the actual effects will be. So I would suspend judgment on whether it has done that, whether it will do all of the good things that it intends to do. Most of them are around transparency, and I think you mentioned earlier, Mark, the notion of kind of unintended consequences, and at some point there will be a what did it bring that wasn't in the good skip when we set out on this journey.
Okay. Alistair, if I may, I'm going to give you a pass on myth because I want to move on to I want to move on to the insurance sector in our whistle-stop tour through the sectors. So you mentioned this earlier, but obviously a lot of review work going on around Solvency II. I mean, the industry spent in the UK about $3 billion on implementing this. It's a decade-long process, yet here we are a couple of years in and we're reviewing it yet again. I mean, do you expect further substantial change to issue from this?
Yes, but don't ask me over what time frame. Because I think there are some overlays here that are problematical for us. We talked about Brexit in the introduction, and the concept of Brexit, and as we don't know where it's going to go, we don't know whether we are going to end up with a regime that is substantially different to the rest of the EU, or one that's similar. We don't know if there will be if it will be recognised. So it's difficult to say. In the short term, we have the Treasury Select Committee banging on the door in the UK. We have EIOPA beginning to look at it. So I expect change, but what change? And I think the EU and the UK is going to start to diverge in its views around it. We know the risk margin, matching adjustments, volatility adjuster here in the UK are all things that we have particular views on. So yes, I was going to see it happen. As a practitioner, again, I would say I would like to see some stability in it, a period of time when we can just learn to live with what we have, to understand our models, understand what the risk in them, understand model drift, and how those things work. So, not a helpful answer, but we've got to live with it.
Okay, now the other area of great change in insurance is the whole Insure Attack trend, and we're seeing we devote a lot of attention to this, a lot of dynamic initiatives going on in this space, but as always there are potential conduct risks around this. I wonder if I could seek Cindy and Alistair's views on those risks, and in particular how also Insure Attack might help mitigate these particular conduct risks. Cindy.
I think there is a great drive and move towards Insure Attack. There's definitely lots in terms of the analytics space, which both in a good way in terms of potential underwriting, pricing, capabilities and helping insurance firms. I think there's definite benefits on that side. But from a conduct risk perspective, there's also the other side. You've got data protection type issues, you've got potentially bias towards certain segments of customers. So I think it has to be used with some caution. There's definite benefits to it, but I think it has to be used in a way with appropriate governance and oversight and challenge to understand, and with a particular view to say, actually, what is the detriment or the poor outcome that could arise from using Insure Attack type opportunities within certain organisations. I certainly know from a UK regulatory stance it's something that they're very acute to. But there are other benefits, so that's from a pricing and product side. There are other benefits because there are a lot of apps that are being developed in terms of claims type technology at the moment, which could actually ease the burden from an organisational perspective, the speed of response with regards to customers and customers' outcomes. So again, that could be a good outcome, but again, used with caution, and I would still emphasise the governance and oversight piece to understand where it could go wrong, because if something went wrong in the underlying models, then that is a systemic risk across your entire customer base. So I do think greater caution in terms of testing the resilience of some of this technology, and also because a lot of it is third-party tech as well. What's the oversight that you have over the outsource and the third party and the type of organisation you're using?
Okay. Time marches on. I'd like to round off the discussion by finalising on the supervisory constants, as we've termed them. And in particular to reflect on some of the two key strategic responses by regulators to the financial crisis around supervising culture and supervising accountability. And we've had a question really as to whether the regulators and also the firms are yet fully got to grips with the issues around culture and accountability. Broad question, but I think a very important one. Alistair.
Have the regulator got to grips with it?
And the firms.
Well, I would put my hand up and say that while I believe fully in having the appropriate and the right culture for our customers, for our staff, for our business, and that we have to lead from the top, I struggle from an audit perspective in assessing it and how to make sure that we're measuring and monitoring it, sort of designing what we're going to look at. And I think that's probably the same for the regulator. Now it's coming. The consultation paper that's out on revising the corporate governance code has a big emphasis on culture, and what is that going to mean? So it's evolving. It's evolving, and I think we will try and influence certainly our supervisors and the firms that I'm involved with in terms of actually understanding what culture means to us, means to our customers, and to work with us on that.
Tom, any thoughts on this?
I mean, we're trying to change it to make things better through culture and otherwise embed that in the organisation. But the first thing, you've been talking, the first thing we then try and do is monitor it via KPIs that don't really exist. Yeah. Try to create new ways of pulling those together and create a whole sort of industry around it. I know that we kind of have to find a way of doing that and looking at it. But I think we also need to think about how these things get embedded, how the culture works from the top to the bottom, how the people at the more junior levels or otherwise in the firms feel embedded and empowered around that culture. And that's not something you can monitor. And I think we're going to struggle until we can get something into there that people feel involved and feel part of. A bit like the kind of old manufacturing companies of the 1900s and things like that, where you felt part of the firm, or the co-ops where you're sort of bought into it. I think it's going to be very difficult to really assess and change it until you got to there.
And the regulators have made clear, haven't they, that they don't expect people to either ask or answer the question, are we there yet?
Yeah.
You know, because if you kind of ask the question or attempt to answer it, then you don't know the journey you're on. And I think that's very much where the regulators are. You're going to keep on reworking it, rethinking it. And
I think to your question, Andrew, I think from that perspective, the regulators have begun to sort of get it, in a sense that they're recognising they can't and don't want to prescribe and identify and set out in any way, but they're beginning to look in a bit more detail about how they go in and make sure that a firm understands its own culture and how a firm understands whether its own culture is filtering through from top to bottom. And it's always been the classic, you can see a bad culture through sort of what happens as a result. It's very difficult to sort of describe what a good culture is. Yeah.
So our time is virtually up, so I'd like to round off the discussion with a simple question, hopefully a simple question, to each panellist in turn. So in literally, and if I can hold you to this, one or two words, what do you see as the one or two most important priorities for EMEA regulators next year? Let's go in series. Tom first. One or two words.
Business models and how to assess them, and models.
Okay. Is it model theme there, Cindy?
Yeah.
Giving clarity in terms of how they're going to assess firms with regards to accountabilities.
I'll say two things: Brexit regulatory framework and regulatory post-implementation focus.
Yeah. I'll pick up Brexit and I'd add convergence and coincidence of regulations, because so many of them are overlapping.
Do I have to be different? I actually would be different. I would say customers and policyholders.
An excellent note on which to end. So, can I thank each of our panellists, Alistair, Stephen, Mark, Cindy and Tom, for really wide-ranging and thought-provoking contributions. We have covered a huge waterfront. Thank you for that. Had a really excellent debate. It remains for me to call on David Strachan to conclude this evening's webcast.
Thanks, Andrew. Thanks very much. I think you and your panellists have done an absolutely brilliant job in terms of covering such a broad range of issues and really giving us some great insights. So thanks again very much from me. I'm going to conclude with two really very short points. First, as many of you know, each year we publish a scorecard. We assess ourselves against how well our predictions have done for the previous year. And as Tom mentioned, I'm really pleased that the Basel Committee has announced this afternoon that it reached agreement on the final elements of Basel III. So they kept us waiting until the 11th hour, but at least we can now tick off that yet another prediction that's been met in 2017. And second, when I think about the regulatory outlook, I'm sometimes reminded of Churchill's phrase, a riddle wrapped in a mystery inside an enigma. So if you ever fall prey to similar thoughts, then I hope that the hour or so you've just spent in our company of these excellent code breakers has helped you solve some of your regulatory puzzles. Thank you very much for your time and attention.